really hard to believe, Peter, that it's 7 months.
Really
And,
something, Joe.
at this point, um, but it's been a lot of fun spending every Tuesday afternoon with you.
Indeed, it has been, sir. It's for me as well.
It really has been super fun, and I want to thank folks for sort of sticking with us. The live viewers, we've had our loyal group. Thousands of people have watched our show as we streamed it out and pushed it out, and it's been very comforting for me, and I really hope it's been very comforting for everybody else for a Tuesday afternoon to really get a check-in. And there's a lot of thanks. If this is going to be our last episode for 2020, and I think it's a good time for a break. I mean, Election Day is next week, right?
Yep.
And then all hell's going to break loose.
Yeah.
No matter where we go.
Yeah.
And then we're into the holidays. So I think it's going to be a good time to just take a break and clear the airwaves and let people do whatever it is that people.
And Joe, let me just make sure I extend early on my thanks and appreciation for the top-notch work that you and your team have done in producing these programs. We went back in March. You and I were talking, as we often do, and what are we going to do about this? We should do something. No one's networking. No one's going out. We should be. The business community is yearning, we said, for some information. That was the impetus, the catalyst to this idea you and your team and I helped hatch. And it's been great. I really appreciate it. It's been flawless execution on your end. Well done for your entire team.
Yeah, and we appreciate your expertise. My executive producer and partner in crime, Lauren Cantor here, she's done a tremendous job really getting the guests, and the guests we've had have been top notch across the board. Jessica, she's helped with all the technology and the social media, and she put together a surprise. It's a video montage of clips from all the guests that we've had, and we're going to show that right around 12 o'clock. I figure we're going to break around 12 o'clock today, being it's just you and I. But let's talk about some things that the last 7 months have shown us, right? So, number one, Peter, I want to talk about is on March 23rd, the S&P hit a low of 2237. Yesterday, it hit 3396, which is 10 points higher than where we were the day before COVID lockdown, right? So, what do you see? What are your thoughts? What do you make of that?
Let me do it this way. I think it's the better way for me to frame my current positioning market-wise, maybe to sort of remove some of the emotionality that investing can often bring, and especially during the unprecedented times that we were in March and April. We didn't know what the heck was going on. Countries were shutting down, and we didn't know. It was very difficult to pinpoint, the next 3 weeks, let alone the next three months. Math numbers often help us to do that, right? Because when you're dealing with the exact science, mathematics, one has the way of sort of removing emotion from the decision-making process, and that's what quantitative analysis allows us to do. So when we looked into that, the following data was that in January of 2020, before COVID, when the biggest thing that we were talking about was the impeachment hearings, we were looking at about $177 a share in S&P earnings. And at the time, the S&P was about a little lower than it is today, which is interesting because you'll see in a moment. And that was equating to about a 19.5 multiple. So remember, what multiples are, how many times earnings are we paying for the market or the investment? It gives us a metric to utilize across sectors, across investments. 19 times is high. It's rationalized because at the time rates were low, and they're lower now. But in any way, shape, or form, you're paying 19.5 times current earnings. you better expect, you better be expecting some growth. And that was what they were expecting. It was 19 times 2020 earnings. And that's about 7 or 8% above what it was in 2019. So we expected some growth in 2020. I just felt things were a little bit too richly priced. And then here comes COVID. And then in the ensuing few months, we are now looking at $125 a share in earnings for the S&P 500. And the S&P is above where it was. So now it's a 28, 29 multiple, 28, 29 multiple. The average multiple of the S&P 500 for the last 75 years is probably 16 and a half. So at 19 and a half, we were high. At 29, it's obvious. Okay, fine. Maybe next year's earnings are going to explode. The aforementioned in the V shape. Well, the expectation for 2021 earnings was only 145. So it's not like we're going back to that 170. In fact, we don't get to 177 probably into 2023. And yet we're priced where we were in January when earnings were a much higher number. So that's where I come out on this. And I say to myself, wait a minute, the numbers don't compute. Well, they do I should say the reason why they do is animal spirits. People are willing to pay more for earnings, humongously more, ergo the higher multiple, because stimulus, zero interest rates, the rah-rah of the technology market, that whole thing has caused the animal spirits to run somewhat amok, toss aside risk and concerns and logic with respect to mathematical numbers, and just say, we're going to think the market should be higher. That worries me. That kind of action, because remember, I'm a fiduciary. I'm not a gambler. I'm entrusted with other people's capital and their dreams and aspirations, the college for their kids, their retirements and their futures. And I'm not one to put that on the line just because things are humming and running and rocking and rolling. I need to have evidence before doing so.
Right. And I think the same way March and April, we didn't know as business owners what was going on, right? The Fed and the Treasury had never seen something like this before. And for me, the PPP program really turned out to be a brilliant program. It really turned out to be brilliant.
Saved us.
It saved us, and the liquidity it put into businesses, as well as the confidence that it kept in the markets. I've been saying this all along, but if the Dow Jones was at 13,000 or 14,000 this whole time, that would have been unbelievably devastating to get through, right?
Right. Agreed.
So I mean, really a brilliant job, and it's not often that brilliant ideas come out of Washington, but certainly the Treasury Department and the Fed really hit a home run, I think, in terms of this. You look at the unemployment numbers, right? And so let's talk about more good news, and then we're going to turn to some scary news, I think, but really more good news. When you look at March, that the unemployment rate went from below 4% to almost 16% overnight, right? And that was about 21 million people unemployed overnight. We forget how scary that was, right? We forget that it was, okay, we're locking down the world economy and everybody's now lost their jobs, right? And that PPP program really, really was a brilliant program. Just supplementing unemployment would not have accomplished what needed to be accomplished at this point.
But if I had told you a year or two ago, or even earlier, the government's going to pay people who because we're in a pandemic, it may have struck you as fantastical or sci-fi or crazy. Just the idea that the government is there to stopgap people's livelihoods and help them get through it, I guess, is part of what a government's supposed to do. I'm sure we're going to talk about the other side of that, and the costs that are involved in that.
Well, that's that exactly. So what goes up must come down, right? So let me throw some numbers at you and let's talk about it a little bit. So the US national debt today is $27 trillion. That's about $83,000 per citizen. And what I find more alarming, and I want to get your expertise on it, is the debt to GDP ratio. So let me tell you the numbers. In 1960, the federal debt to GDP ratio was 52%. In 1980, the debt to GDP ratio was 34%. In 2000, it was 55%. And today, the US federal debt to GDP ratio is 137%.
Right. Yeah, we have about a $20 trillion economy GDP wise and 28 trillion federal debt. Just as a clarification point, if we add in
Well, there's $55.9 trillion in household debt as well.
80 trillion all in, when you add in household, consumer, corporate, municipal, city, 80 trillion. And going higher, by the way, not lower.
Right. So if I was a business, that would mean, my debt is 137 times what my income is, right? And at that point, there's no business. So we really, what does that mean though? What are we looking at long term?
Well, remember, unlike a business, you can't just continue to print, CMM dollars, but the United States government can. So do they, there's a theory out, and the big advocate for this theory is an economist at Stony Brook, Stephanie Kelton, MMT. In the future, we should try to even get her on, because it's very interesting what she's saying. And the advocates for her theory are saying that when you have a government like the United States, where you could print your own currency, debt doesn't make a difference. You just keep printing more. Yeah, that sort of strikes me as a little odd. But again, I'm not going to, I'd welcome the debate, but I'm sure she has her empirical evidence. But it just seems to me that, leverage is a killer. I mean, it always has been. You cannot, business or any other economy or in finance, too much leverage does hurt. When it's zero interest rates, I guess they could pretty much continue with this high leverage for a period of time, until the bond vigilantes come back and they start saying, "Hey, we need more payment on these bonds in order to buy them, because the United States has got a high GDP to debt ratio." So that we haven't seen that yet. It may be coming.
Yeah. So unpack that a little bit, right? So I'm not an economist, but my understanding of my college days, economics about supply and demand, right? And so the more money, inflation rates are affected, interest rates get affected. So are we looking at high inflationary times ahead? How is that all going to play out in your mind?
Well, so yeah, I would tend to. I'm leaning more towards the inflation models a couple of years out. I don't think we're going to see that until we get a curative process to the virus and to the economy. But I think all of this stimulus, and remember, it's global. It's not just the United States. All of these dollars and euros and yen that are floating around, they cause more. They cause prices to go higher. And it is sort of supply and demand, right? You've got a limited supply and increased demand, and you're going to have higher prices. And that's sort of how I sort of see that. Now, again, the other takeaway from this is this idea that the currencies, be it the aforementioned, euro, yen, yuan, or the dollar, they would likely get weaker as you have more of them. Think about a pizza pie. You have 8 slices. Now, another bunch of kids come over. You got to slice those 8 into 16ths, and everyone's getting a diluted share of that pizza pie. Well, in the same token, if you have more and more dollars floating around, the value of each dollar gets shrinks, and that's called debasement of the currency. And so that leads in many macroeconomists to consider the value of gold. as a store of value, and some are even taking it to the next degree and discussing cryptocurrencies and such. I'm not ready to go that route just yet, but it's interesting is the notion that you need a store of value that's not going to be diluted away, as apparently we're seeing that happening with paper currencies.
Yeah, and look, inflationary rates have held. I've been very surprised that they've held, right? Which is good for us because there's more dollars and we're actually able to hold our value of the dollar and get a full dollar's worth without inflation chipping it away. But we have budget deficits, right, that have to be accounted for as well. So this year alone, we're more than $3 trillion in a budget deficit, right? And that's also bonds that have to be sold or debt that has to be incurred to cover that deficit. And that was what you were talking about. I can't print my own dollars, but this is how the federal government prints its own dollars. Hey, we spent $3 trillion more than we expected, so let's go out and find how to do this. Right?
Crank up the presses, more printing.
Yeah. The interesting thing too are you mentioned the bond raters that are going to come out.
Yeah.
I mean, I was looking, so in February, the 4-week T-bills were paying just 1.6% interest. Now they're paying 0.09% interest on the I mean, who's buying them?
Zero.
Who's buying them though?
Well, I think banks have to buy them. There are certain restrictions, there are certain requirements that banks have to have a certain amount of their capital in treasuries. It's sort of like that, there are requirements for that. But I'll tell you that no individual investors are buying them because, essentially why? I guess money market funds buy them, right? And it's as part of their portfolio. But yeah, I think the bond market's a really dicey trade in here. And I would, my thinking on bonds right now is that we're going to be in after this 35-year historic, amazing, unbelievable run that we've had, remember, well, I guess, we're too young to remember, but back in the in the early 80s, people were buying houses and they were doing a 16% mortgage. When I bought my house in '93, I had a 7.5% mortgage. Now kids today, or young people today, are buying homes and 2.5%, 3% mortgage. We've had a huge run, partly due to deflation. It was tamed, and partly due to these lowering of interest rates. I think that's reversing. I think over the next 20 years, we're going to see interest rates. Not immediately, but they're going to probably go higher as inflation begins to take hold. And it's just not inflation; it's also the debt levels. Remember, if I'm buying the United States bond and it's fully backed and it's got full faith and credit of the United States, and it's a risk-free asset, right? But that risk-free asset is based on economics and the value of the country, and that country's got 130%, GDP to debt ratio. You sort of wonder to yourself, is this really a good trade? Is this really a good investment? And I'm sure it will be. But then you have Moody's or S&P come out and they say, okay, well, that's United States. I know you could keep on printing, but that's not really what we're looking at. We're looking at the numbers, and you know what? We're gonna bring it down to AA. So now maybe that happens, maybe that doesn't. So these are the things that are out there that are very disconcerting and worrisome.
Yeah, I mean, I guess thank God the interest rates have been as low as they have consistently because people are turning to the market because they don't want to gain less than a point on their money, right? But I remember I mentioned my economics class at Stony Brook, and I remember the professor then saying, if you want to retire rich, just save $2 million and put it in a savings account at 6 or 7%, and you're set, right? And he said, I can never see interest rates going lower than that.
Yeah, right.
And here we are. I
remember
right?
that class. I was in that class. I remember that. And yeah. I mean, listen, that's the nature of interest rates, because what he was saying is that the money will double every 10 years at 7% roughly, and so how are you gonna lose? And it's guaranteed. What he didn't factor in at that point was this historic reduction in interest rates. And while you're right, it does does position or push investors into this idea of the wealth effect. This was the idea Bernanke had after '08 was let's bring interest rates down. And back then down was 2%, not zero, but we're different times today. And that will force investors into riskier investments, ergo, stocks, and then stocks will then go up because there's more buyers. And if stocks go up, companies could do more, transactions. They could do more M&A, and that causes the whole motion of the economy to move forward. And I get that. It just strikes me as a little, I don't know, a little artificial, a little pushy, a little like they're making it happen. And that kind of worries me, because as a fundamental analyst, I'm always looking at what the company does, what they make, how they make it. Is it sustainable? Will it be here for a long time? What are their margins? I'm not looking at people buying it just because they're forced to buy it. I'm looking at the internals of a company. And so it's kind of an odd time right now.
Yeah, and you and I have talked about it. I mean, delevering risk for me has been a big issue, right? And we've talked about it a lot. And real estate's been helpful. So these historic low interest rates have allowed the home market to really stabilize and really explode, particularly here on Long Island, where people are getting out of the city. The real estate market. So it'll be interesting to see what the housing market does as well as interest rates creep up.
Joe, you're an expert in this PPP to some degree, more so than I am at least. Do you have to pay it back? Do all these companies that got this quote unquote helicopter money, do they have to pay it back?
If they used it for payroll, rent, and operating utilities, and they meet the brackets of where your employment needed to be at the end of forgiveness period, then no, then it becomes a grant.
And not taxable either? They don't pay taxes on it?
Well, that's the big question. So right now, and we're waiting for more guidance to come out, and there's going to be more stimulus to come out, and that's the challenge. Right now, you don't get a break in terms of the expense. So I have that cash. I was able to use it as a bridge, but the money we used for payroll isn't able to be netted out. So you ultimately.
Oh, I see. Okay.
See what I'm saying? So it becomes, well, and look, will they keep it that way? How else are we going to pay back the taxes? I mean, how else is that going to be paid back, right? So Mnuchin has to figure this out, but how else is it getting paid back?
To me, it's a moral hazard. What a country. Something happens that goes wrong, don't worry. Your company's going to be fine because the government's going to bail you out. I don't get that. That's not 101. That's not economics. That's country taking over and giving out helicopter money to people who need it. I mean, I get it. We needed it. It was understood. Without it, we would be in a lot worse shape. I get it. But it creates a moral hazard that suggests that whenever something goes wrong, don't worry about it. Take the undue risk, Mr. Investor, Mr. Business Owner. Reach for the risky investment because you know what? If it blows up, everyone else will blow up and again, the government will come and rescue you.
Yeah, precedent.
Something that strikes me as wrong about that.
Yeah, precedent's going to be interesting with this one. I remember 08, 09 when they bailed out, what was it, Bear Stearns? They forced the sale and then let other banks fail, and that became a very difficult situation. But
right, and I hope there's people that haven't sort of played games with this PPP. I mean, I assume that there probably are people that didn't really need it, that took it more than they needed. I'm sure it means a lot of money sloshing around in a short period of time. There's probably a lot of that kind of nonsense going on. So to me, I don't know. It just I call me a purist, but I think that folks have a responsibility to manage their financial affairs in such a way where if something goes wrong, God forbid they get sick or God forbid something happens in their business, they have the ability to help themselves and keep themselves going and keep their employees employed. It's not the government's job. This was different. I get it. I understand that. But it does strike me as a little bit irresponsible.
Yeah, well, in law they call it the force majeure clause, right? They shut it down and basically said we're going to give you a 2-month bridge because it's nobody's fault. And I got to tell you, it really
It's important.
Hindsight is 2020, but at that particular moment, living through that with all my clients, if the government hadn't have done that, Peter, I don't know where we'd be right now.
We'd be in a lot worse situation. I mean, I definitely agree they had to do it.
Emotionally and mentally, people would have not had the ability to move forward. And I want to segue because I'll tell you some themes, right? And really, hats off to our A-list guests that came on this real show. And what I learned is what we already knew, but was proven, right? So test and verify. But that is, especially here on Long Island, that the human spirit is absolutely amazing, right? It's absolutely amazing. We were the hardest hit here in New York. The industries that we had on in terms of sports and transit and real estate and the arts, media, they were the hardest hits. And every one of our guests were still positive and optimistic about what the future was going to look like and what the future was going to hold. And that's what struck me out of this whole season that we had was just, no matter what was happening, everybody still believed in themselves, still believed in their teams, still believed in their business, still believed in the economy, still believed in America, right? And if we didn't have this show and we just listened to the partisan news outlets that are out there, we would have never gotten the ability to really hear from boots on the ground what they were doing and how positive they were,
and how they pivoted in the face of adversity. Think about the guy who runs a construction company, and because of the spring and the COVID, he was essentially shut down. But he didn't go he didn't go home and cry and sort of woe is me. He figured out, hey, you know what? People are gonna need these plastic dividers in restaurants and everywhere else. So you know what? I'm gonna retool my workshop, get my people in there. Of course, the PP money helps, and I'm going to get this thing retooled. I'm going to start selling, stanchions, little framed out plastic things that I could start selling around town to all the restaurants and different retail establishments. That kind of pivot, that kind of ingenuity, that's America. That's American business, and I love it. I think it's so strong.
Yeah, it's been really overwhelming. So we put together sort of a video montage of a clip of all of our guests. I want to show that now and then come back for our final thoughts after the video plays. I think the viewers are really going to enjoy this piece. So if we could run that video, that would be great. Our hope is to have these every week at this time to help businesses, business owners, and folks navigate through these really weird and uncertain times.
I think it's all of our jobs to give each other a little bit of optimism in these times, and I think there's real reason for that optimism.
Joe, I want to be optimistic. I want to think that the entrepreneurs that created the change in the Long Island economy continue to do that, continue to evolve.
I think the one thing that's keeping me motivated, and I think it should keep everyone motivated, is we're all dealing with this.
We have lots and lots and lots of people, even if they don't talk about it, who are experiencing some of the same things that we are. Try to do things every day that give you a sense of control.
I've seen so many interesting pivots and opportunities taken advantage of as our normal world stopped. It's actually I'm quite optimistic.
I do give a lot of credit to our Long Island businesses and businesses across the country who are really innovating, being creative, and just keeping the lights on. And not all of them obviously have been able to do that.
I believe in people. I believe in human capital, and we can invest in buildings, but if we don't invest in human capital, shame on us.
And I think as long as we always put in the equation of safety, I think you can do that.
I actually think that, the human spirit and the entrepreneur spirit is probably now more present in all of us than ever.
I think I think people are supporting local businesses. I think for a while we moved away from that. I think it's coming back now.
I feel better now that there's a clear recognition of how critical it is not just to allow businesses to open, but figure out ways to be supportive of business.
We can treasure the silver linings that we can identify of what we just went through. We can see our local economy, our local community emerging stronger than ever before. And the key is just for us to continue to work through this together, and the potential is limitless.
You do not have to learn by going through what I went through in order for you to get the lesson.
You don't have to lose to learn, but if you lose, you damn well better learn.
We're going to get through this, and I think we're going to come out of it stronger, and we're going to find new ways to reach people and new ways to engage our communities, because at the end of the day, we need to be out there more, finding out what people need.
So I have been spending a lot of time mentoring, finding opportunities for people, making sure we're listening to our staff members, understanding what it is that they need.
You know, I know that it's not necessarily easy on Long Island or in New York in general, but that's what makes us tough.
I think that we are Long Island strong, and I think we have to remind ourselves that we are Long Island strong, and we will get through this, and we will get through it together. We will be different, but we will get through it together.
You know, I see a lot of optimism on the back end of this, and I do think there's a lot, from a business perspective, there is going to be some pent-up demand. But things will look different, and it's incumbent upon leaders, you know, to navigate that and to adapt.
It's going to take all of us together to help higher ed, to help our local businesses, to help the people in our own communities to get through this for the next, hopefully not too many more months. But
I think we'll move forward out of this pandemic within the next 6 months.
Hope is that the scientific process will predominate and we will win the battle. I actually have a lot of confidence that we will win the battle.
We're here and we're not going anywhere. We're here. We're working hard today. You know,
everything's moving in the right direction. We're ready. We're safe. We're clean. And this is going to be complicated, but it will not be unsafe. And I look forward to getting back to work on a full schedule.
The one thing you don't have to worry about in Suffolk County is your public safety. We have your backs, and we're not going to miss a beat no matter what the pandemic throws at us. And you have enough to worry about. We all have enough to worry about with our personal and financial lives. We'll keep you safe.
And we are committed to creative solutions to helping businesses and communities and residents weather this storm to make it through to the other side.
It's business unusual. It's unusual times, folks. You know, we're really trying to help everyone figure this out and figure it out ourselves. So here on Long Island, we can stay safe and stay strong.
We don't know how much longer this environment is going to be with us, but just the fact that we're able to pivot and operate and do so virtually and do programs like this just shows you the resilience of the American spirit and the American economy.
Really great to relive all of those guests there. What a really great.
That was amazing. That was amazing.
Right? I mean, wow. Really gave me goosebumps just sort of reliving that, Peter. So,
yeah.
You know,
again,
final
hats
thoughts
off to you and your team. Great job.
Yeah, final thoughts for you.
Well, I think the final thoughts are, folks, we're not through this yet. I mean, that, you know, what we've been through may have just been the beginning. I am very resolute in my belief that science will prevail and we will have treatments, vaccines, approaches. I'm also confident that the American people, our fellow neighbors and friends and foes alike, you know, folks that we know around, are going to be more empathetic, you know, and less sort of divisive about public health and the protocols that are best practices with respect to public health. And to that end, I am confident that we will get out of this, but I am not, you know, believing it's going to be like this. I still maintain that it's going to take some time. Behaviors have changed. Thinking has changed. And so this all takes time. And to that end, I would suggest a careful, you know, a carefulness with respect to financial matters, as well as typical business matters, reduce debt, save for a rainy day, the typical kind of thing. Don't reach for the highest rung just yet. I mean, we'll get there, but we got to get through this next 6 months, and I think that's going to be key.
Yeah, I agree. There's a process, but I am starting to see light at the end of the tunnel, right? I really am starting to see light at the end of the tunnel. My daughter and I were talking the other day, and she's like, we're so close. She's like, sometimes I forget, about COVID, and then something reminds me. But we've made so much progress, particularly here on Long Island. I don't know, the national debates that are going on here on Long Island, man. We have been united. We have been cohesive. We have been strong. We have been safe. We really have been leaders, really leaders. Little old Long Island,
yep,
the world through a pandemic. And I got to tell you, I've never been more proud to be a Long Islander. I've never been more proud to have a business here on Long Island and to have worked with these folks here on Long Island. We made it, right? We made it to this point, and it's unbelievable how far we've come in 7 months, really.
And we were hit hard. I mean, hats off to our healthcare workers, and were indefatigable in their efforts to save others. Winthrop, Stony Brook, other hospitals, Huntington, all the hospital systems, Northwell. Outstanding work. You're right. I believe that Long Island is a gem and something that others will look for when the books are written about COVID. I think we'll see how Long Island is still a leader, and how we definitely came out of this very strong.
Yeah. So I guess final words are thanks to everyone. Thanks to our viewers, really, for making us feel special for doing this and making it feel like they had some value. Thanks to our team here, Lauren, Jess, Jen, our IT manager, who made sure everything ran smoothly each week. Jen, we appreciate that very much. Thanks to you, Peter. I know this.
Thanks to you, Joe.
Time for everybody. And folks, just hang in there, right? We've made so much great progress. We need to stay safe. We need to stay strong, and remember, we need to vote, right? So early voting is open. We need to get out there and vote, because if you don't vote, don't complain about what's going on. So from all of us to all of you, we'll see you next time here on Business Unusual.